Have you ever opened a trading account? If so, you've probably had an experience like this. You buy a stock or a coin, it drops to -10%, and you think, if I just wait a little longer, it'll recover. So you hold on. And then it falls to -30, -40%. Today's topic is the stop loss. But this video isn't about pep talks like, stay mentally strong, or just follow the rules. Instead, based on what economics, psychology, and empirical research have shown over the past decades, this video explains why a stop loss is not a choice, but a necessity. First, let's look at one statistic. In both the United States and Korea, individual investors consistently underperform the market. Why is that? Is it a lack of skill? A lack of information? No. The biggest reason is simple. They don't cut their losses. Not cutting losses isn't about weak willpower. It's because the human brain itself is designed to avoid doing so. In 2002, Nobel Prize-winning economist Daniel Kahneman and his colleague Amos Tversky introduced prospect theory. Its core idea is simple. Humans perceive losses and gains of the same size very differently. Specifically, losing a certain amount of money feels about 2 to 2.5 times more painful than gaining the same amount feels pleasurable. As a result, the brain tries to avoid locking in a loss at all costs. That act of locking in a loss is exactly what a stop loss does. What's even more interesting is how people behave once they are in a loss. When we are in profit, we tend to act cautiously. But when we are in loss, we take irrational risks. Holding a position that is down 10% while telling yourself, if I just wait a little longer, it'll recover, is not a sign of weak mentality. It's simply how the human brain works. In 1985, Shefrin and Statman discovered a strange pattern in investor behavior. They found that people tend to sell assets that are in profit quickly, while holding on to assets that are in loss for a long time. This phenomenon is called the Disposition Effect. Logically, it should be the opposite. Assets in an upward trend should be held longer, and assets that are declining should be sold quickly. But in reality, investors behave in the exact opposite way. Why does this happen? Holding a profitable position feels psychologically uncomfortable. A fear arises. If I don't sell now, this profit might disappear. On the other hand, a losing position creates hope. If I sell now, the loss becomes real. If I just wait a little longer, it might recover. When this pattern repeats, an account becomes structurally fixed, with small profits and large losses. Even if you win 8 times out of 10 trades, 2 large losses can wipe out all the gains. This is the most common path through which individual investors end up with negative long-term returns. Many people think of trading as a prediction game. Was I right or was I wrong? But professional traders think differently. Trading is a probability game. In fact, many successful traders have win rates below 40%. Out of 10 trades, they lose 6. And yet, they still make money. How is that possible? The answer lies in the risk-reward ratio. They build a structure where losses are kept small, and wins are allowed to grow large. When expressed mathematically, this leads to the concept of expected value. Expected value equals the win rate multiplied by the average gain, minus the loss rate multiplied by the average loss. Even with a win rate of 40%, if the average gain is just twice the average loss, the expected value is positive. But without cutting losses, this structure completely collapses. Small losses are no longer controlled, and eventually turn into 1 or 2 large losses. No matter how good the expected value of a strategy may be, the account eventually collapses. In financial engineering, there is a concept called risk of ruin. For a strategy without stop losses, the risk of ruin approaches 100% over time. No matter how lucky you are, it means that eventually the account will disappear. Avoiding stop losses is not a problem limited to individual investors. Even institutions made up of the smartest people in history have collapsed because they failed to cut losses. In 1998, a hedge fund called Long-Term Capital Management, or LTCM, went bankrupt. The fund was composed of brilliant minds, including 2 Nobel Prize winners. Their strategies were statistically sound, and in the early years, they generated enormous returns. But in 1998, an unexpected event occurred: the Russian moratorium. Their positions began to incur losses. The real problem was that they refused to cut those losses, believing, "Our model is right. The market is wrong." Within just a few months, $4.6 billion evaporated, triggering a crisis serious enough to threaten the entire U.S. financial system. In behavioral economics, there is a concept called pre-commitment. It means setting rules in the present to control your future self. It's like not buying snacks at all when you're on a diet. In trading, once you set a stop-loss price in advance, the decision is already made. When the price reaches that level, the position is closed automatically. There is no room for emotions like, "Should I wait just a little longer?" The biggest difference between professional traders and amateurs is not mental strength. It is whether a system exists. Professionals design their rules so that they operate before emotions can intervene. A stop-loss is not a trading skill. It is an automated decision-making mechanism. A stop-loss is a survival system built on the assumption of human irrationality. It acknowledges that the human brain is designed to avoid losses and creates a structure to bypass that instinct. Trading is not a prediction game. It is a probability game. The market can be wrong at any time, and our judgments can be wrong at any time. What matters is who survives longer. A stop-loss is the minimum rule required to continue playing a probability game. The moment you reject it, trading turns into gambling, and the probability of your account's ruin converges toward 100%. The most important thing in the market is not being right. It is surviving. And a stop-loss is the most fundamental rule that makes that survival possible.